good morning, everybody. Welcome to today's panel, How Entrepreneurs Scale. My name is Anthony Bontrager. I'm a managing director at WestRiver Group and the co-head of the firm's Pacific Northwest Fund. For those of you who are unfamiliar with WestRiver Group, we are a early stage venture capital firm and growth stage debt provider based here in the Northwest with a little over $2 billion of assets under management. Today with me are three experts who have had hands-on experience with growing and scaling businesses, each of whom bring a unique perspective to this very simple question, how do entrepreneurs scale? So to start with, we have Marty Roberts. Marty is the co-founder and CEO of Wicket Labs, an audience insights and analytics platform to the media and entertainment industry, and soon to be Nielsen killer in this $400 billion market space. Next is Laurel Buckner. Laurel is also a managing director at WestRiver Group and my co-lead for the Pacific Northwest Fund. Prior to WestRiver, Laurel had run two successful corporate venture capital funds, and previous to that was the general counsel at SonicWall during its $1 billion acquisition by Dell. And finally, we have Kiran Bhageshpur. Kiran is the co-founder and CEO of Igneous Systems, the leader in the unstructured data management space for the enterprise, a market that measures its data growth in zettabytes and is growing almost geometrically at scale. And speaking of scale, a recent report that I read a few weeks ago from the Global Entrepreneurship Model stated that there's 100 million venture capital-backed companies starting every single year around the world. Each one of these companies are trying to scale as quickly as possible before other entrants enter their market space and start taking away their market share. Truly economic Darwinism at its best. But yet to scale implies that you're able to grow your revenue with very little to no incremental spend, from an operational perspective. And yet startups, by definition, have to grow their revenue by a correspondingly increased amount in the actual spend themselves. And so this is the conundrum we're going to unpack today, whether companies should scale, how to scale, and how to differentiate that from actually being in a growth phase. So let's unpack this, if we will. So Marty, I want to start off with you. So as the CEO of Wicket Labs, this is your second time, in the CEO chair, having previously, been CEO of the platform, which was acquired by Comcast. Setting aside the obvious, how do you contrast where Wicket Labs is today versus where the platform was when you were at the company? And what was the nexus point that told you that the platform was actually at the point where it's ready to tip over from pure growth to scale? And how are you taking those lessons learned and applying them to what's going on at Wicket Labs?
Yeah, so, when I left the platform and Comcast about 4 years ago, we were about 230 people, about $50 million in run rate revenue. But that inflection point of when to move kind of out of that growth phase and really get into that scale phase really came down to really understanding the repeatable model that we had, that we understood what our sales process looked like. We understood how our marketing process was going to look. That's not to say it didn't change over time, but we had a good repeatable process. And so it's at that point when you can throw some fuel on that fire and start to light things up. Sure. In terms of how we thought about, or how I thought about the differences there, so the playbook is the same. It's vision, it's objectives, it's strategy and tactics. And all of that lines up very well. Wicket is 15 people now, same recipe. And yet the differences for me are twofold. The first was my perspective on time. So, when I was managing a couple hundred people, tens of millions of revenue, I'm thinking about what are we doing this quarter, what are we doing this year, what are we doing over the next 5 years, and keeping those perspectives in frame. Today, I think about what am I going to do this week, and that's the most important thing. I think about what am I going to do this quarter, and then I think about what's our North Star, where we're going to be in 3 years. But I can't get much further than that. And so we're measuring our decisions based on, are we tacting too far away from where our North Star is and where we want to be 3 years from now. So it's a different kind of perspective on what we focus on. The second thing I'd say it's really interesting and different is, at this stage, part of your job as a CEO is you're identifying friction in the business, and your job is to go solve that, either with people, process, or technology. And so, at this stage, it's visceral. You know exactly where there's friction in the business. You know exactly where what you're going to hit for scaling. At the same time, when I was running the platform, I had to really invest in a better feedback loop around What are those quarterly objectives on each of my managers, and how are those filtering down into the organization? Are they aligned across the board there? Thinking about how you're actually setting up tripwires on major initiatives to make sure that they're on track along the way, to meet deeper into the organization, not just with my direct reports, but to really figure out what's going on, and in particular, to find those Cassandras that are beware the Ides of March kind of feedback that you always don't want to hear because they kind of feel like, I don't know, it's kind of like working with Eeyore, it always rains on my birthday. But those people are super perceptive about where the problems in your business are, and they can identify issues a lot of times way ahead of where everybody else is. And so that feedback loop and investing in that was really important in that scale phase, because you just can't keep track of where everybody is on any given day.
That's a really good point, because I think what you're kind of starting to tie into this is the avoidance, or the ideal avoidance of technical debt, right? Because as the company scales, sales are obviously going to be ahead of product, typically in an early stage startup. And if you're not building the infrastructure and having that feedback loop, you will find yourself in a situation where you can't support the growth that you've worked so hard to actually accomplish.
It's exactly right. I mean, there's always that, you're constantly thinking about, when you're in that growth phase, it's just what's the next feature, to win that next customer, to kind of work your way through that product market fit evolution. But as you're scaling, if you hadn't been investing in the whole time, and it's a classic mistake for startups where they really start to rocket out of the gate, but they've just been, patching things together and keeping the lights on with baling wire and duct tape, et cetera. And so when the scale hits, things start to break. And that could be in the product itself, it could be in a sales operations role, it could be marketing in all aspects of the business. Could be a legal issue where it used to be easy to just, throw a person at it. Now we have to scale up the number of deals we're doing. These are all things we have to think about investing in as we transition kind of out of that kind of scrappy growth phase and into that scale phase. Do we have the right foundation in place?
Excellent. Thanks for that. So Kiran, let's approach that same question from a different angle. As a first-time CEO, you're arguably in the midst of a very high growth phase of your business, right? So how are you looking at your business strategy in terms of growth versus scale, and kind of what bumps have you experienced as you go through this evolution for Igneous?
I'll take a slightly different approach of growth versus scale and say it's always about, from a startup point of view, how do you scalably grow, right? Or how do you scale growth itself? And what I mean by that is there's a stage in the company early on when you are essentially sort of trying to go find that product market fit. And once you do, you start sort of growing pretty aggressively. And that changes if you have not set, and it changes at every single stage, from 0 to 1, 1 to 10, 10 to 50, 50 to 100. They're all very different sort of sets of problems that you have. So when I think about this and I look at this really boils down to the same set of things, which is people first. Do you have the right people doing the right jobs? It's product, because most of us from a technology point of view are product led in the way we approach our customers. And only then is it process. And when we look at things like process, it's all about what is required today. Don't overdo it, because you want it to break as you start scaling, because you don't know what aspect breaks, but you'd rather let the data and experience tell you so that you can fix the right thing. Because many companies, including us, we are always sort of built by, I think we can see further ahead, and the real answer is you can't. You got to let the data tell you. Yeah. So the worst thing you can do is build too far ahead, either in your product or in your processes or in the people, right? All of these things, from a people point of view, forget about hiring somebody who is right for you when you are 100 million. It's who's right for you now, wherever you are. That's the sort of thing that we think about it.
So kind of build and break fast, because you're going to learn through that iterative process, and ultimately that's going to, build much better muscle memory, I think, for the organization and make it stronger long term. Is that kind of what I'm hearing?
It is. I mean, in fact, if one of these folks, I forget who it was, made that statement very explicitly. It might have been Reid Hoffman or somebody who said, please build your processes which are guaranteed to fail. In other words, that's how you know that you have hit a particular escalation point or an sort of inflection point.
Fantastic. So for everybody in the audience, it's okay if things break. Just just go with it. It's part of the process. Laurel, so you've evaluated, a number of different companies at both their growth and their scale stages from an M&A and investment perspective. What are the signals that you look for in determining where a company is in its life cycle? Is it in the growth phase or the scale phase? And how do you evaluate those from either an acquisition or an investment perspective? What are the key metrics that you're going for?
Yeah, I think it's a good question when folks are in the startup world, aren't totally sure how to engage with a large acquirer. So I would say large acquirers often look for the technology, the product, and really the revenue that's being generated by the startup at any given time is more about proving that the product is in market and there's in fact a customer base that's wanting to buy it, right? So it's sort of just proving out the technology. I think large acquirers often see and build their own internal business cases around how that product or technology is going to fit within their own product suite and their own product offering. Is it a new feature? Is it a new product? Is it something that's a piece of technology that's going to wrap into a larger product that they're going to sell? So really revenue is just viewed as a validation. And then the scaling part comes after the acquisition once that product is in with the large acquirer.
Gotcha. And then what about from an investment perspective? How do you look at that from a different lens, if you will? Or is there even a different lens?
Well, it's a good question. I would say, so we're doing seed and Series A, right?
Yeah.
So as Kiran says, these are early stage companies that are very focused on that revenue trajectory and trying to figure out, is there a product that will sell in the market? How do you build that customer cohort? How do you quickly scale? How do you keep the customer cost of acquisition relatively low in order to continue to build that revenue? So I would say, the increase in revenue growth is obviously something we think a lot about, but in our own investment memos, we have a point of view about when that company is going to be able to get to scale, where we believe that product is going to go. So it's not as though we don't think about that at all, but we're very focused on that revenue growth trajectory at the investment stage.
Interesting. So if I could dial back on the M&A piece, growing versus scaling means different things to say the different acquirer and what they're looking for. It could be a product plug-in, like you said, where they've already got kind of that scalability engine, and so they will take it from the growth to the scale. Or if they're looking for an adjacent market entering point, right? For the data and analytics space in the media industry. Let's say Discovery said, hey, look, we want to own this because we think it could be an adjacent market for us. Then the scalability factor becomes, I think, much more of the high order bit in that kind of discussion, if you will.
Yeah, if I can just jump in there, when EMC acquired Isilon, which I was there, it was totally a scaled business, and in fact, to this day, it is left alone for all practical purposes as standalone because it's grown really nicely. And at that point in time, you're buying not just the technology and the leadership in a given market, but the scaled processes, because that's what they're counting on, right? And it was a cash flow generator for EMC and later Dell as you've gone through the last 5-6 years.
Absolutely, and a public company at that time. So not a startup, but a very mature, working very well at scale, large company.
And you've seen that trend line now with a lot of companies getting acquired literally weeks before they are going to go IPO. Happened with AppDynamics. There was noises about that happening with Datadog.
That's right. That's right. Now that's an excellent point. And so actually for you, Kiran, so how does a company go about the growth and scale, or growing and scaling successfully, right? And what are the quantifiable metrics that you think are important, to determine whether or not a company is truly at the point where they're ready to scale, or they should stay kind of in that growth phase? And I'd like to learn, what you've taken away from your time as part of the senior leadership team at Isilon, right? And how are you applying that into what's going on at Igneous today?
Yeah, look, you are ready to start scaling or scaling growth when you have repeatability, when you have predictability and repeatability, right? Again, the experience at Isilon was kind of really, the acquisition was kind of pretty good there because we set out goals 5, 6, 7 quarters out, and we were able to go hit that pretty consistently. And that's just a sort of process across a variety of functions. So when we look at even at our stage right now, which is sort of the beginning of growth, if you will, we look at that and say, can we be predictable about the output of any function such that if we invest X dollars, people, whatever it is into a given function, do you get a leveraged output from that? More engineers means more product features as opposed to taking longer time to churn. More dollars into into marketing means that you actually have a highly leveraged demand generation machine. So that's kind of the first thing that you look for. So it's really all about, do you have repeatability there? And for us, especially from a business, it's pretty easy to go measure repeatability, which is, hey, how many new customers are requiring, how big are the initial transactions they're doing with that, and how significant is the expansion business they do within the 1 quarter, 2 quarter, 1 year after that initial sort of land.
Exactly right. And ARR is obviously an output of all of that, right? Which is kind of the big metric we all look for, right? Absolutely. So Laurel and Marty, so what do you think about what Kiran has just shared in terms of his experience, right? And has that been your experience, right? And what other factors do you guys see maybe that be in addition to what Kiran has just shared?
Yeah, I mean, I think those are all great insights. And just to take it sort of a step further, looking at what you've said about building those processes, putting them in place, I think it's really important, especially for early stage companies, to think that scaling is not simply going to be, a lot of times people talk about the flywheel, as though it's just going to be operating onto itself, right? Kiran's smiling over here. So once you hit that, those few pieces in your business, it's all going to be up and to the right, and the flywheel will just continue to spin from in a virtuous way. I think really it's a step function. So things break, as you described, and really to have the ability to move the levers to understand, is it in fact that our marketing machine is not scaling? Is it that we need to in fact hire more people? What exactly broke at this point? Then it becomes the step function of growth and scaling, as opposed to what the flywheel metaphor means that it continues to generate on its own.
Well, I want to dive into a couple points you just made there, because you talked both about growth and scaling and this stepping function before the flywheel effect takes into place. And I think definitionally that stepping function is more in that growth phase of the business, because you don't know what you don't know. You are breaking things fast and learning from those and letting the company get to that repeatability, that predictability phase. But that does take some time, right? So I think to Kiran's earlier point, not everything is up and to the right. Once you hit certain things, things are going to change. And so I'm curious, Laurel, when does the stepping function change, or does it change, right? And when does it become a little bit more linear growth?
Business, even though you in fact may be at scale.
Yeah, I fully agree with what Lauren said, but just to go back to what you said, I look at the step function as a little bit differently, which is it's not a step function in terms of what your output is in terms of ARR or what the end result measurement is. It's really a function of your process and your scaling sort of metrics, if you will, right? If you do it well, and certainly many good companies do it really well, it all looks magical and perfect and wonderful and linear. But behind the scenes, everything's breaking, and it breaks in different ways when you go from 0 to 1, 1 to 10, 10 to 50, 50 to 100, 100 to a billion. And even after a billion, you will see folks like, hey, I'm not the right person to take it from 1 billion to 10 billion, so somebody else is going to go take over. That's just kind of very common to see that, because it's very different set of processes, people, sort of metrics which take you to that next level. But if you do that right and you anticipate that, the output looks magical. Oh, it's simple. It's just easy, right? It never is.
Never look behind the scenes is what you're saying.
Never.
Okay. That's a great distinction. Marty, what are you thinking on that?
So, I think that the stumbling blocks in the growth phase and even into the scale phase often come when your ideal customer profile changes over time. So as you start out early, you've got enthusiasts that just love your tech or love your idea or whatever, and they're super invested in it. And that even into that early majority where they're looking at it and saying, I get a competitive advantage if I'm doing this, if I'm investing in this kind of technology. But as you start to get into an early majority where the buyers shift and the features can change and the requirements can change around that, your internal processes, your story, the marketing team and sales team need to bring to market becomes very different at that, because the the decision criteria that those customers are using to evaluate you versus maybe some competition that's now come into the space, things like that, becomes really, really different. And so oftentimes you'll see that the processes you set up initially for that initial customer and wrapping around serving that initial customer don't scale well. As you get into a later stage in the company and you're really growing it up. You have to think a lot differently about how you approach your customer and how your features roll out to those customers, and even how often you deploy new features becomes very different in a scale up than versus at that early stage where you're just.
That's an interesting point. So how do you know when your customer cohort is starting to change, right? Or you're finding that you're either upselling, right, into the market space where your total contract value is increasing with these customers, or you're actually moving into a different vertical that you never really kind of considered at the outset. I mean, what are the, I guess, not the metrics, but really, what are the flags for you that inform that decision?
Yeah, so the biggest thing that you'll start to find is, the requisite is you have to spend a lot of time with your customers out on the road, even as senior executives, because what you start picking up, when you have sales reps that are translating back into the organization, you always get a filtered effect. Whatever the most strategic thing is whatever closes the next deal. It is not the thing that's going to break your company in 2 months or 3 months and things like that. And so you have to spend that time, and what you start picking up are different titles, different people are in the room. I'm in an enterprise sales space, so it's often a consensus-driven decision that happens around these bigger enterprise deals. And so you start to find different types of characters that you're talking to essentially in that. And the questions start to evolve. The feature requests become much less about just can you do this to, well, can you just add this little polish, and can you sand off this little burr that's on the side of your product, and that's important to them. And before you could kind of blow that stuff off, but as you get into a more mature phase, those little incremental features they catch in the overall process. And so that's, it really comes down to, spending a lot of time with that customer base and seeing how the conversations change over time, and then figuring out, okay, what that really means is we have to come back, reset our marketing, our positioning, our go-to-market strategy, and then even our product strategy to address these new customer needs.
Interesting. Kiran, I know you've experienced this recently with Igneous, right? In terms of, the customer demographic, not necessarily changing, but kind of expanding what it's looking for from you, which has had some really positive effects on some of your core metrics, right? Talk a little bit about that, if you would.
Yeah, so I have a very visceral way of thinking about, when are things changing, right? First 10 customers, the founding team is calling on every one of them and it's closing every one of those deals. Maybe the next 50 to 100 customers, the VP of sales and the senior leadership from a product point of view are calling and touching every single customer. At some point in time, it's only occasionally happening, right? And so at some point in time, you're only touching a smaller and smaller percentage of your customers, and that's a good sort of measure of sort of where you are on that scale. And I mean, to me, it was at Igneous, it was a big step when we closed our first deal without me talking to that customer, and then we had a customer which expanded twice where I hadn't even yet talked to them, and I go, whoa, something's working out here, right? And then you go, hey, turn to the VP of sales and say, when's the first deal that's closed that doesn't involve you? That's another inflection point from a scale point of view. And what Marty said there is really good. That a customer is really, especially we are in the enterprise space too, and for an enterprise customer to do a $100,000, $200,000 deal as a pilot's completely reasonable. They're spending a lot of money on these problems, right? But that they are serious about you after they've done the initial transactions, and then they ask you for, I call them dull and boring features, but that's what they need to go do a global deployment. And you look at that and say, oh my God, that's boring. But that's really important, and that's when okay, now we are having a serious conversation which can sort of result in you as a company sort of really delivering value and becoming a standard across the organization.
Interesting, because I know you guys have experienced that in a number of different ways, and you're finding that your average contract value is increasing as a result of that, right? Because you didn't realize that some of the features that you had maybe thought about, but like you said, boring, right? really became the linchpins to those expansion deals, which is really where you understand that you're now truly at that growth/scale kind of nexus point. And I think that's an important distinction to make. Yeah. We've got a little bit of time here, so I'd like to open it up to some questions for the audience. So does anybody have any questions for Marty, Laurel, or Kiran?
So distinctions of scaling between service products and hardware products, and whether that matters or not.
So the question was the differentiation between scale from a service product perspective and a more hardware-based product, and what are the differences there?
So when you say service, are you talking about software as a service? Okay, SaaS. Look, today there are fewer and fewer companies that need to go sell a hardware product unless you're in the consumer space, right? The cloud has really changed things. So even people who were traditionally sort of selling an appliance of some sort have moved into a much more of a software only and a software as a service only model. We have definitely gone through the transition. The biggest change that comes along, especially in the enterprise space, is not having to go put a piece of gear in a customer's data center for a customer to be able to try your solution, to be able to go experience your product. That's a huge, huge lever, right? If you're selling them something that involves an appliance, involves hardware, you got to go ship something, and that's inventory cost. You got to go put it in a data center. There's friction involved. On a SaaS solution, click, 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 and you're good to go to start experiencing that. And that's definitely been a huge, huge shift for us as we've gone through those transitions. And look, growing and scaling a business today, which involves hardware going into a customer's data center, is much harder than scaling and growing a SaaS-only business. And to be transparent, investors, unless there is a really compelling reason as to why your hardware is differentiated, do not want to go look at that. Customers don't want to go put yet another piece of hardware unless there's some unique differentiation. And the markets, both public and private markets, sort of reflect that view and mentality.
That's a great point, Kiran. And I think just to dovetail on that and using Igneous as an example, you guys started out with both an appliance and a software-based platform, and then you migrated to your pure SaaS model. And that in and of itself has its own set of risks, right? Because hardware can make up a very significant portion of your revenue before the actual ARR starts to tick up on your software solution. And that's a really delicate balance. When do you make that change? I mean, it could be market driven, it could be financially driven. So talk a little
answer
about
that as soon as possible. It's 100 times, 1,000 times easier earlier rather than later. Let's take an example in the public markets of a company which went through the transition as a public company. Nutanix did that. Nutanix was selling appliances. They had a big deal with Dell, but they've gone through modifying their model from sort of appliance-based perpetual license revenue stream to a ARR subscription revenue stream, and they did that as a public market, and they had some stumbles along the way. That's really rough to go do that. Sooner the better. And so we did this essentially after first year of revenue, and that's much better to go do it that early because it's still only a small number of people get to see the sort of churn that goes on as a consequence.
Marty and Laurel, on that same topic, I mean, you guys, I know Marty from the platform, with the video distribution you guys were doing, you had your own iron. And so you're working with those similar types of vendors. Laurel, I know with, GCI and others, you were in that same spot. Was that kind of, a pain point for you having to go, here's yet another hardware vendor who wants to put iron in my basement, right? So.
Yeah, always. So the barrier to entry was just so much higher to talk about, hey, are we going to rack this up into our data centers and keep this rolling? And we were at scale. We were doing, about 2 billion video views per month that we were managing across all of our media customers. And so we could afford our own data centers, and we had economies of scale because of the volume we had. But I couldn't imagine repeating that same, infrastructure build out today, or it just makes no sense for the business. So, hardware is harder for sure.
Go ahead.
Well, I was just going to say I would echo that too. The first startup I was at in 2004, Avantail, we ended up selling our hardware business, keeping our SaaS business, and made that transition maybe 2005, 2006 timeframe. So I think this has been something that's hard for startups when they think they do need to have proprietary, even back then when you needed to have a blade. And so the sooner you can move away from that, the better. And certainly in the cable provider days with actually having CPE, switching that out, that just becomes a huge cog that it is a real drain on profitability.
Sure. Yeah. Look, we've gone through these sort of waves, if you will. We're definitely in an anti-hardware going into a customer's data center today. Yeah. And that's primarily because there is very little value in anything that you are doing from a hardware point of view. I'm not saying that's going to be always the case. There's this whole slew of new companies which are building proprietary silicon and systems for AI and for machine learning, modeling and processing out at the edge. So that's probably going to go turn around at some point in time. But in general, if your appliance or your hardware is essentially Intel servers or ARM servers running some OS, Linux, I mean, there's not much of a choice. Why would you do that as opposed to sticking it in AWS or GCP or Azure? You don't like that? Maybe there's some other people that would like. That's really a really hard thing for a company to do, for a customer to do.
And I would say, just to echo that point on the edge, because I think that's really where a lot of development is going to be happening as to where it sits on the edge. Is it going to be in the cloud? And both Azure Stack and AWS Outpost have proprietary hardware that they will put at the edge. And so for a startup or a new company to try to come in and compete with those very large companies that already have large hyperscale cloud presences, I think is a real challenge. But that will continue to be a very interesting place to watch as the compute processing becomes better and better through these proprietary systems.
I think it's cyclical. I think we may come back to a hardware-based, a little more receptiveness, both on the part of the customer and investors. But I think you're right, Kiran. Right now, there's I think very little appetite.
And the place where there is actually a good market for hardware out at the edge is actually the consumer space. If you think about it, not just your iPhones and so on. It's the speakers in your home, or all of that stuff. That's kind of where it is, or Nest. That's kind of where the hardware-centric sort of models have really played, because their simplicity matters, and just plug and play and good to go.
Excellent. Any other questions? Yes, sir.
Yeah, a question about the hardware versus SaaS. In the telecom industry where I'm in, sort of hardware is seen as capital expenditure, whereas SaaS is OpEx. So do you have any, I like the SaaS, but do you have any tips on how to move customers over to that?
So the question is, in the using the telecom space as an analog, which is very hardware intensive, how do you get the customers to move over to that SaaS business, right? Because you're right. I mean, that market specifically is going to be changing. So Laurel, you want to start with that, having come recently from the telecom space?
Sure. I think telecom is changing tremendously. Yeah. You're seeing distributed networks. You're seeing core features that are being pushed to the edge. And most of the large providers are trying to switch to an OpEx model as opposed to a CapEx model, where you have to buy a lot of core gear to run your network. It's going to be fascinating to see how, I'll just call them networks in general, are going to be architected for the future. And people talk about 5G, but that will certainly be, and we'll add into edge compute, the capabilities that'll be provided. If you're wanting to incentivize customers, I think, to move now, and certainly you guys have both had the experience where you're moving from a hardware software solution to just a software solution, I would say customer incentives, because you know the value, when you look on your balance sheet, you know how much that capital is that you're actually holding. And then what's the incentive and what can you give to incentivize customers in order to move? I've certainly seen that in the telecom world, moving off of old networks by even handing out new phones or whatever is required to move the customer onto a new model of service.
So Laurel, on that point, is it more of a situation where, for an incumbent telecom provider, let's use wireline as an example, it's more about the layer 4, layer 5, network applications that sit on top of the glass that's already in the ground right now, not really a factor of placing in another DMARC closer or out to the edge, if you will, right? So it truly is that application layer stack.
Right, at the application layer, then you've got to really prove the customer value, right? Because that tends to be a noisy space for telecommunication providers, where there are a lot of other companies that want to grab that customer's attention. So why the telecommunications provider would be the best one to deliver that service, and it may be through the value of bundling, it may be through other value adds, it may be through a customer service delivery, sort of a one throat to choke, if you will, and that's why the telecommunications provider should be viewed as delivering that, layer 7 app, if you will. And I think that continues to be a customer value proposition.
What will 5G play? What role will 5G play in that piece? 'Cause I think it's actually a really interesting question as the communication is evolving, right?
Yes.
And you're looking to scale.
Yes.
This is a perfect example. So I assume 5G will play a significant role there.
Absolutely. I mean, the
Okay.
cost of just delivering the service with 5G is going to be coming down significantly, again, because of this distributed architecture that's being brought into, I'm just going to call them next generation networks, and new spectrum that's going to be delivered. So I like to see it as the world of ubiquitous connectivity in 5 years. What is that going to enable from a solutions point of view? How is that going to make your business easier and your business easier if we're not tethered to these things? So changing the business model completely with lots of opportunity for new market entrants. It's very exciting.
Thoughts, Kiran?
Look, when you said telecom, I had this sort of, PSTD flashbacks because I spent all my 90s working for datacom, telecom companies, including having a company that I worked for get acquired by Lucent, which doesn't exist anymore. And that's a different world. It just depends on what layer you are in. If you're sitting at the physical layer or layer 2, well, it's hardware. You're going to go through that whole process. Good news is if you succeed on that, each of your POs is going to be $100 million, straight off the bat. Great power. If you're up in the application layer, that's kind of where the space is. And here's an example of a company which is not telco, but has created a telecommunications service on top of existing networks and is really richly valued, Twilio. I mean, it basically makes the job of setting up, point A to point B connection really simple and API driven, but it's all leveraged. That's a higher level service that, these guys are going to have to deliver more and more of as they go along. And all of that is going to be service based because what did they do? They came in and said, hey, it's really complicated for you to go do this. You got to set up all these, network associations and all of these relationships. That's going to be expensive. We'll take care of that stuff. We'll just charge you on every message you send through. Whoa, did they grow? Have they been a good IPO? It's been good.
Yeah. Right. Excellent. Marty, any thoughts? Or?
No, I mean, having spent 10 years for a big cable provider and things like that, we've been through that progression. But I would say even in that particular, and to your point, I think that the biggest initiatives were moving to more of a cloud-based infrastructure, even inside these big cable operators, these big telcos, so that they could more rapidly deploy. You'd look at startups that would just, they'd say, hey, we want to sell into this particular space, and they just die on the doorstep waiting to get out a pilot, just knocking on the door, hey, have we certified my box yet? Or, and you're like, I'm running out of cash. Have we certified our box yet? And it was just, it was a really hard sales process to get through. And the space is pretty littered with companies that wanted to pull that. So, I think if there's a play in hardware, as you said, the consumer space with the combination of 5G over time is going to get really interesting again. We might see things swing back up. But that's, a couple years out in terms of the horizon. So on the horizon. So.
Gotcha. Great. We have time for one more question. Anybody have a question? Okay, well, great. We'll wrap it up. So let's just leave the audience with some final thoughts here. Just talking about getting back to the growth versus scale piece. So Marty, let's start with you. Any final thoughts you want to leave the audience with?
So I guess what I would say for my final thought is that you can't underestimate the what I would call an intentional culture. Every company has a culture. No matter if you've declared what your values are and what you measure yourselves by. But if you can set up an intentional culture, it actually allows the company to go a lot faster because employees know what their objective is. And really, as long as they're within the boundaries of, hey, we're not bouncing up against one of the walls of one of our cultural values, they can just go as fast as they want to. And so it really sets up a framework for them to feel successful. Decisions get made against, not because, Marty said so or somebody else, at executive said so. But it's really, we want to go there, and the way we're getting there fits within the framework of our cultural values as a company. And it just allows the overall organization to scale a lot faster. And I think people underestimate the value of having an intentional culture versus one that just kind of casually develops when we get into that scale phase. And you see a lot of companies that stumble because their culture gets in the way of actually growing the organization over time.
That's an excellent point. Laurel, how about you?
Yeah, I was thinking a lot about young companies wanting to scale, and I've been focusing a lot on that revenue growth at the early stage. But I think scaling is incredibly important. When you do that and when you're able to do that, you have a lot more options. And options are the key to being able to make decisions about your business. When you have cash that you can make decisions about investing in teams, growing new products, thinking about entering new market segments, expanding geographically, making acquisitions, you really, as the company, as the CEO, have so much more optionality in your business when you're at scale than when you're just focused on growing that top line. So I do think it's something that every entrepreneur should be focused on. To Kiran's point, from the very beginning, right? I think you said scaling growth, right? So that is a very important thing to be focused on, because then you'll have more options.
Excellent point. And Kiran?
Hey, I'll sort of take it in a slightly different way and may talk about financing and generally raising capital. And I'll do that in the context of, just before this session started, we were talking about growth at all costs, massive capital raises. Look, I was a working stiff in the 1990s, so I saw the whole dot-com bubble crash down on our heads. And eventually the sort of music does stop. And if you have not thought about sort of scaling growth systematically from day zero, you're going to have a problem. That's number one. Number two, the way to go do that is raise only as much capital as you need, as opposed to as how much you think you can, right? And there's another piece of that. You'll end up usually raising more than you think you need, or more than you really want to if you're a frugal mindset. But then I had a great phrase the other day which said, the best startups and the best businesses are the ones which have deep pockets and very short arms. So, which is great, which is perfect, which is, you want to have the optionality of having lots of dry powder, but you want to make certain that you're very thoughtful about how you're investing, which goes back to, you do not try to grow at all costs. You grow in a scalable manner, which means you have repeatability and predictability across all areas of the business, and that's when you're ready. Look, it's no longer fashionable, but the first startup that I worked for, which I started in 1992 and went public in 99, 98, we had 12 quarters of consecutive growth and increases in revenue and profitability. You don't see that very often these days. And that was at a like 40 million revenue run rate. It's just like unheard of these days, right? I mean, NetApp, one of the companies in our space, went to IPO with 17 million in revenue and was profitable at that point in time. So, different world. I think it all comes around in a circle.
Totally agree. Excellent. Well, thank all three of you for participating in today's panel today, and thanks to our friends at GeekWire for hosting such an amazing event. So please, everybody, enjoy the rest of your show. And thanks for attending.